Okay, welcome everybody. This is round two of the Castle Law podcast, version 2.0, I guess. Now we're doing it via Zoom, where we're here to create businesses worth owning, careers worth having, and practices worth owning, lives worth living, and all of those other great things. As we're in this pandemic, one of the big things that those people who are involved in rental properties are really under a tremendous amount of stress relative to whether rent is going to be collected, how rent is going to be collected. And I wanted to get two of my really good friends, big industry leaders together here. Lots of different strategies on how to own rental properties. Some people are owning in C and D neighborhoods. Others are owning in A and B neighborhoods. Both Ben Walhood and Jared Kott are two clients who have totally different investment strategies, yet are involved in the exact same game. They're doing property management of their own properties as well as others, but doing it in totally different areas. So for those people who don't know Jared is primarily on the south side of Chicago. He has manages about 300 units, a couple hundred of his own. He's been doing this for about 7 years. So can you imagine the trajectory of the amount of purchases he's been doing the last 7 years? Doing it extremely successfully. Ben, on the other hand, Ben Walhood with Apex Landlord Services. Ben's been investing in A and B areas, primarily in the western suburbs. So a much higher price point. Again, owns about 100 of his own units, manages a couple hundred units for other people. He's involved with investors from finding, fixing, funding, and managing properties. But both are doing exactly the same thing. So, guys, Jared, your investment strategy is primarily acquiring these rentals in C and D neighborhoods. What's the impact of COVID on your portfolio and that of your clients?
Well, first off, Gary, thanks a lot for having me. And, to Ben, I have a lot of respect for his group. I know his partner well. So to answer the question, the impact right now, believe it or not, is somewhat minimized. I don't think April for us is the problem. I think that we are going to see some pressure and strains come May, June, possibly July and onward. But remember, answering that question, the majority of the holdings portfolio that we own, about 67% of that is subsidized through Section 8, subsidized through other federal agencies. So that money is continuing to come. There are portions that we need to collect from our tenants. They're lower. And let's just round the numbers up. 30% of that is market tenants. And we're faring okay at this moment. We were down last week about 7% month over month, and the majority of that has really been pushed to the market proportion to that.
Now, it's interesting because when I was talking to Ben before our phone call, Jared's like, Ben said, I've been real lured about buying in the south side of Chicago, and Jared's over there making these super high returns on his investment. But this is exactly why I invest in A and B areas, because in these times of crisis, my portfolio is a lot more stable. Ben, how are you doing with the A and B neighborhoods?
Well, Gary, likewise, thanks for having me on here, and thanks for stirring the pot a little bit already. Have some fun. So far so good. Similar to Jared, I think for most people, April wasn't too bad. For most of these people, the ones that got laid off or furloughed or whatever, they still collected their March income. So we actually had 100% rent collection for April. We had one tenant asked to pay half on the first and half on the 15th. A couple of them paid a few days late, but that's typical. So we actually, if I didn't turn on the news, if I just looked at the rental portfolio performance, wouldn't even know we're in the middle of a crisis right now. Now, to be fair, hey, May, June, July, just like Jared said, I think for everybody across the nation, it's going to be a little more difficult. But I do expect for the caliber of tenants that we have to see that much more dissipated versus, the C and D neighborhoods and those types of tenants.
So Jared, basically, he said his portfolio is more protected from these shifts in the market. What say you?
Well, I mean, there's two schools of thought here. We're really happy, as I said, with the returns that we've gotten so far. But if we forecast, and this is hyper focused on the south side of Chicago, I really believe that we are moving, and I don't want to make this political, and I'm not going to take a side either way on this, but I believe that the city of Chicago is moving a little bit more towards a progressive lean. And you can also see with the federal government, with stimulus package coming out, some discussions about, increased payments to individuals. I actually think that would put our tenant base in a much stronger position than A and B neighborhoods.
Okay, so what I'm understanding you to say is you're betting on the government and Ben's betting on the people.
Correct.
Is that a fair statement? Okay. Well, the government is seemingly getting more and more involved in things, so perhaps that's a good thing.
Well, I think the difference to clarify there though is, I mean, so you got the subsidized housing, like, yeah, I mean that's almost as good as money in the bank for that portion of the rent that is covered by the government. But as far as the tenant portion or your market rent tenants, they may get stimulus from the government, they may get money put into their account, but I would expect that those are the types of tenants that are, posting on Facebook, hey, let's go on a rent strike. We don't need to pay right now. Let me take that and go, buy something else with it, versus the types of tenants that we pursue. We purposely go into these neighborhoods that attract high quality tenants, and we give them a high quality product so that we can get somebody with, like, yeah, maybe job stability is sketchy for everybody across the nation right now, but in general, they've got a higher job stability. They're more white collar workers. They can work from home, that sort of thing. Which is very specific to this scenario, a tangible benefit we're experiencing right now. But the bigger thing that we look at credit in a big way as a predictor of future behavior. Now, when we took rent, we took our applications and looked at credit history. We weren't planning on who's going to pay during COVID-19, but we were looking for who's more likely when the chips are down, they lose their job for a period of time, or they didn't make as much or whatever, who's more likely to make whole on their rent if the economy turns down a little bit, or if something happens to this particular tenant. And somebody with a good credit history has proven they're far more likely to pay their bills even when they're having challenges.
And how about, oh, by the way, before I ask the next question, for the participants that are in the room listening, go ahead and put your questions up on Zoom group chat. I can see those, and I'll be asking Jared and Ben their opinion on those questions. Jared, I just want you to know, Ryan, the #1 REO broker in Illinois from Remax Western Springs, he mentioned on the group chat here that Stevie Wonder could see that betting on Chicago government is not a good idea right now. But that's
I appreciate it. Yeah, no.
Go ahead.
My bet is more on the federal government. These funds are not, yes, they're being siphoned through the Chicago government, but that the federal government is going to be there for the people. And if you don't see that, just imagine what would happen if either party came up and said, you know what, I just don't believe in housing, and we need to cut housing. It'd be chaos. It would be anarchy. That's my personal opinion. And I'm wrong every day, but that's my personal opinion on that.
Jared, I can't agree with you more. I mean, it's certainly something that's been a rock bed of the United States. And if the real estate market tanks, and certainly our president, the Congress knows that. And obviously they've extended now the next stimulus bill and gotten together, and they finally agreed on that. I'm curious, multifamily versus.
Real quick, Gary.
Go ahead.
With that being said, would you take a bet with us, with your own liquidity on the south side of Chicago?
Would I?
Yeah. If you agree that the federal government is in a strong position to take care of housing, and we can make a proof that our returns are phenomenal due to that approach and then systems, would Castle Law be a good liquidity partner for Marblestone Property Group?
Well, I wouldn't want to come in and take over and ruin your parade over there. You know, I'll stick with, you know, I've been investing in commercial assets, so I'm out of the housing market. I'm heavily involved in commercial. So that's my niche. Maybe we can do another webcast on that, but all my residential assets are gone as of December of 2019. So maybe some people can call me the smartest person in the world for getting rid of them. I don't know, but I am out of the rental market as far as residential goes. Multifamily versus single family. What's a better place to have your money right now during the shift? And should people still be buying assets?
I'll jump in quick on the on that. So again, I think both models work. You know, Ben touched on it. Whether it's a lower income approach that you're focusing on, or A and B class neighborhoods, like Ben said. I mean, you really got to underwrite the person or persons that are going to be living in your asset. I found, and it's not just my opinion, it's through data, that tenants typically stay longer in a single family home. So my opinion, great bet there. Even better bet if it's subsidized. There is certainly a little bit more turnover in multifamilies, but that doesn't mean that many people turn multifamilies into their home as well. So I think that they're both good bets. If you put me on the spot to say you must only choose one, I would take the bet on the multi-units right now, just because you can pick the number, but if it's a 4 flat that you got into with minimal amount of money, your returns are phenomenal. And if one leaves, even if 2 leaves, depending on the price point that you purchased, renovate, and was all in for, you can cover your debt service and expenses. So I think it's a great bet. And lastly,
what do you think about that?
Should people be buying now? I mean, we're looking to purchase now, but very selectively. The word isn't out like, send us all your deals. We're selectively buying, and we're looking for, obviously motivation there to get some discounts. So I think, there's always room. I personally think there's going to be a lot of opportunity in the next 12 to 18 months.
What's interesting, and Ben, I want you also to comment on that, but before I forget to mention this, was speaking to the vice president for the Midwest for Chicago Title on a conference call with Frank Montrow Tuesday morning. And he gives us weekly stat updates on shifts in the marketplace. And we're going on the second consecutive week of an increase in new contracts in the Chicago market. So last week we had a 17% increase in total new properties under contract in the Chicago market. Now, year over year, we're way down, but we are actually seeing consumer confidence increase pretty dramatically. And I don't know if it's because some of the stimulus money's working. I know that we filed on behalf of a lot of our clients. Our firm actually received a large sum of money for the payroll protection plan, as well as multiple economic injury loans. And I know a number of our clients that we filed for also got those. So I don't know if that has something to do with it, but we are seeing now some increased consumer confidence in buying properties. Ben, what do you think?
Yeah, so my philosophy there is actually pretty similar to Jared's. We're being pretty choosy in the market right now, just kind of seeing where the chips fall and how the dust settles here with the market. Grabbing really good opportunities if they're out there, but passing on the stuff that we might have squeezed through 6 months ago. Because I think, the latter half of the year and going into 2021, I think you see a lot of opportunities, both in single family and multifamily, but for different reasons. As far as which one of those is the better product to be invested in, right now or over the next 6 to 18 months, we've seen multifamily, we've seen those apartment buildings just skyrocket in value over the last decade, right? Because rents keep growing, net operating income keeps growing, and so that pushes up the value of those buildings. But those are only being purchased by investors that are confident in putting money into the marketplace versus sitting on cash. Those people can choose whether to just stop buying that product for a year if they think the market's going to be a little bumpy. Whereas single family homeowners, the types of houses we're invested in, right? They're $150,000 to $250,000 valuations. Those are first time homes. Those are people that they had a kid, they need a house. They have a dog and 2 kids, they need a house and a yard. They need a basic commodity, and they will continue buying that house. That's going to prop up the value of those single families. We're not going to, I don't think you'd see the single family value crater in the way that multifamily potentially could, because the pool of buyers for the multifamily is just investors. If the appetite goes to zero, it's an investment. It's not a requirement for them. So your pool of buyers could disappear overnight if they get skittish, and values can drop very rapidly.
Where do you see the big opportunities that are coming in? I know, a lot of these different national investment groups, and whether, Renatus or whatever, all these different groups, everybody preaches leverage, right? And leverage is both an investor's friend as well as an investor's enemy. And, what I've often cautioned my clients on that are investors is the need for that rainy day fund, or the need for those reserves. So with the onslaught of, more or less anybody in the entire world who has 2 cents to rub together has always considered investing in real estate. And many of these people have engaged in this BRRRR strategy, which is, buy, refinance, and, rehab, refinance, pull all your money out. They don't have even a month worth of reserves. Do you see that as a major problem? What do you think is going to happen in May, June, July? Do you think that your success that both of you had in collecting rent is going to start to decline? And is that going to provide an opportunity for short sales with investors, a lot more REO inventory? Put a lot of stuff in there, but what are your thoughts on some of that?
So I think in the multifamily side, we're going to see a lot of people that are unable to collect rents and wanting to get out of that game, managing those tenants and trying to collect the rent. I think you're going to see people, the kind of the mom and pops that have got the multifamilies, dumping them because it's just, a pain in the neck to try and collect those rents through June, July, August. And come the second half of the year, they're completely burnt out and they're spent. And again, those mom and pops probably didn't carry the reserve that they should have if they got, 1 or 2 properties, something like that. I think on the single family side, I think those opportunities are going to come a little further down the track, leading into, foreclosures coming 6-12 months down the pipeline, if not longer, just because of how backlogged that system's going to be. So I think you're going to see opportunities in both space, but for totally different reasons.
Yeah, the Cheshire cat in the bottom right-hand corner's got a big smile on his face when he hears about the additional foreclosures. As Rosario has named Ryan the most, the most
optimistic,
positive person in real estate.
Most positive guy in Chicago real estate. Yep.
Yeah, the most positive guy in Chicago real estate. Jared, any perspective on what Ben said?
Yeah, I agree with a lot of it, and I think if Ryan's been wildly optimistic, he's going to continue to be that way because last week we heard things of the expenses. He talked about the impact that taxes are going to have moving forward. I was just on I don't want to go off on a tangent, but I was just on a webinar with the Southside Builders Club where the Cook County assessor came in, and they're making some changes there, but taxes are definitely going to go up. I think on paper, the newer investors may catch a little bit of trouble here, because on spreadsheets, let me tell you, whether you're in an A, B, C, or D class neighborhood, everything looks good on paper, right? And what did Mike Tyson say, right? It's like, we've all got a plan until we get punched in the face. Well, right now, some of us are getting punched in the face. And really, I think this one is just a quick little jab. But I do think that there could be some roundhouses coming. So, I think the people that are going to fare well are people that kept their LTVs low, their loan to values low. I think the people that are going to fare well are ones that have a pretty good operating system prior to COVID. Like, if people don't pay, what are our steps? What do we do? How do we move through this? But I do think that there's going to be some problems for people that may have looked at leverage as their best friend. This can turn around and just, it's like just shooting venom right in their face. So it could be a problem.
So the real question for the 50 or so participants we have now, what's the one thing that people can do to minimize their risk in rental properties, both now and just in general?
I'll jump in here with a really quick tip for people that maybe self-managing a smaller portfolio. So, and this is going to pertain, it certainly pertains now during the crisis that we're in, but I also think that it works, when things get back to normal, if you will. We didn't create this prior to COVID, but we did during COVID. And we basically imagine a blank piece of paper or a spreadsheet with three lines drawn down the middle. So you have 3 columns. And what we put are, solid tenants are going to pay, no issues, everybody's line itemed out. Section 2 is we have some tenants, they've reached out to us, we've reached out to them, they're still communicating, right? They want to pay, but maybe they need a little bit longer in time. So not a code red, but a little bit of change. And then to the right in the columns, like, we have a problem here. This is code red column, and that's lack of communication, maybe stated, I don't have the money, I can't pay, I'm sticking my head in the sand. I think that somewhere or another, we're all going to run into at least a tenant with that, and we want to be prepared for that. So we've been reaching out even like real early in the crisis and letting people know, hey, we know that your world has changed. Our world has changed too, right? We know that your employment may have changed. Our employment has changed too, but we've still got some bills to pay, and we want to work with you. Now, as mentioned earlier, I have a holdings company, so I can do things a little bit differently, and I'm also not over leveraged. What I want to do is just to make sure that the money comes in. I'm not, in this time of crisis, for the personal portfolio, I'm not looking for every nickel. Right now, we're not at that stage where we're getting into workouts. Say somebody owes $1,200, I'm perfectly fine taking $1,100. Perfectly fine doing that. I just want it to keep flowing in. So I think that if you look at what are your total expenses for that property, whether it be a single family home, a duplex, all the way up to a building, figure out what it's going to cost you to keep that building running and what it's going to cost you to pay your lenders, and begin communicating that. Like, get the understanding of what that is and make sure you have to get that money. There's also some resources out there. I'll be happy to share them. I don't know, I could put it on a Facebook chat or something. With the city of Chicago's got some grants going around. The team in the office is doing a great job. Remember though, those things take time, and no pop shots at the government, but the government works slower, in my opinion, than the private sector does. So if you get somebody to agree to a rental assistance program, understand that that's not going to be a couple weeks out. I'm sure Castle Law is probably, well versed in some of those things as well. So you might want to reach out to them to get some assistance on how to handle that.
Yeah. So Ben, I'm going to get to you in just a second. One of the things that I really, always stress to my clients is, and everybody that's listening, when the governor stated that there was a stay on evictions, let's just break down what that means. That means that the sheriff will not physically conduct an eviction. That means that the process in court may be stalled. But what it doesn't mean is you still can serve a 5-day notice for non-payment of rent. You still can file an eviction. And what I will tell people is this, especially when it comes to evictions in Cook County. We can always slow down the process, but we can never speed up the process. And we need to operate our rental properties like a business and not treat them like our children, where if we give them an inch, they will take a mile, right? So we need to make sure that if they don't pay, we need to calibrate our expectations of them immediately. Get that 5-day notice served, file the eviction. Because when we come out of this in June, July, and August, for those of you guys who remember the Hillside Strangler, it's just backing up, backing up, backing up. So everybody that filed an eviction in January is going to go first. So if you have a person that's currently not paying rent and you don't get that eviction filed now, you're going to be looking to 2021 before you're getting court. So you might as well save your place in line now for the to minimize your risk and maximize your return. And you can tell your tenant, look, my objective is not to evict you. My objective is to obtain rent. We understand that we'll put you on a payment plan. We just need to be sure that on the backside of this, if you don't get back in line with things, we're going to have to get that asset back. So Ben, Jared,
Gary, you're muted. Gary, you're muted.
Oh, go ahead, Ben.
No, I think it looked like you muted yourself there. Yeah, so it's funny. The last two questions to me kind of blur together and encompass this whole thing. So how do we minimize risk for rental properties, and how do I avoid evictions if at all possible? I mean, look, crazy things are happening right now. It doesn't matter if you own A, B, C, D, or Q properties. Like, everybody's going to have some sort of challenges going through this. But in general, we have preemptively reduced our risk. Maybe not specific to COVID. Again, nobody saw this coming. But in general, market downturn and economic downturn, we protected from that risk for the same way for the last 15 years. We look for good quality tenants. We figure out where they want to live. We figure out what product they want to live in. We go find it. We build it. We create it, and we provide it to them. And by working in that order, when we put our property on the market, it's a good quality product in a good quality area. It attracts high quality tenants that have good credit history, have good income, have good job stability. Ideally, it's a multi-income household. And all of those things drastically reduce our risk. Is it going to be the end-all be-all solution to collecting 100% of rent through this pandemic? No, there is no such thing. There's no silver bullet for that. But I think the likelihood of us getting most of our rent and the unlikelihood of us having to evict a bunch of our tenants or threaten to evict a bunch of our tenants, I think we're in a really good spot because of the strategy that we go through. So, whether it's specific to COVID or economic cycles or any of the factors of real estate trying to reduce risk, I think it's you get a good quality product, you rent to a good quality tenant. I think that will always be the best strategy you can use. You put a little bit of the reserves on top of it, like you mentioned earlier, and you can weather just about any storm.
And Jaime from down in Joliet, he was asking if we're still buying, what comps are we using without knowing where all this is going. One thing I would say to that is, number one, if you're buying rental properties, you're buying based on your return on investment, or a new concept that Rosario from Click Invest has come up with, which is return on your equity. And for those people who would want to reach out to Tommy Schrey at Click Invest, he can explain more of that. But really, when you run your numbers for a rental property, it's just like owning a stock, right? My portfolio for stocks, I think I've lost a couple $100,000, but I'm not cashing them in. So this is a long-term play. So if that thing's cash flowing, you're running it based on cash flow, not necessarily based on value. For your flips, flips are a little bit tougher, and obviously we don't know where this is going. And then coupled with that, there's another question, and then Ben, I'll have you chime in again here. How does this crisis compare or different from the 2008 recession in terms of buy and hold investors? Well, first and foremost, the 2008 recession was a recession. We're not currently in a recession. We have not hit a recession. We have not hit a depression. That was an economic cycle, a cycle that we were anticipating was going to come in 2017, in 2018, in 2019. We don't yet know whether this is a blip on the radar. Prior to COVID, obviously, our economy was gangbusters. Unemployment was at an all-time low. Consumer confidence was higher than it ever has been. So we all can prognosticate on whether things will immediately rebound. I think it has a lot to do with how fast the country gets back to work, and how long we can endure this. States are beginning to open up. If this comes back in June, I think that, personally, we're going to have an Indian summer where we're going to have a massive rebound. The market reports showing that there's properties still being traded. Things that are being placed on the market are selling immediately if they're good purchases. All indicates that the undercurrent is still very, very strong. That's just my opinion. Ben, what do you think?
So the question was comparing 2008 to now?
2008 till now, and what comps are we using if we're still buying right now?
Okay, yeah, so in addition to the points you made, I would say on comps, we're just using the same exact comps. I think it would be really subjective to try and use different comps because, right, you should be looking back 3, 6, maybe 12 months. So whether you look back 3, 6, or 12 months, none of that's yet been affected by COVID. So rather than changing the comps, we're just simply using a lower LTV or ARV on the back end, right? So a ratio, like instead of we want to be all in for 70% of ARV, we'll use the same comps and try to be all in for 65% of ARV. So I would adjust it that way rather than going after different comps. And then 2008 versus now, in my mind, one of the perspectives on it is I think 2008 was a lot more of a balance sheet problem than an income statement problem. Meaning that the valuations dropped, right? Nobody was buying, so whether single family or multifamily, the values dropped because there weren't any buyers. Hey, Jared, welcome back.
Thank you. I hope I didn't get disqualified by the technical difficulties.
God, what is that?
TKO,
Technical knockout?
I don't know. I had to reset routers and stuff. It was a big mess.
No worries. We covered for you.
So yeah, so 2008, I think the tenant pool was actually got really strong in 2008, 2009, and 10 because people lost their house and became renters. So it was not an income statement problem for investors. It was a balance sheet problem. The value of the properties plummeted. Whereas here, we're not having value issues yet. I'm optimistic we won't have that problem, but I think realistically we've been due for a market cycle anyway. I think this is just going to be the huge catalyst that tips it. So I think the next 3 to 6 months is going to be an income statement problem, a P&L problem of lack of income, whether it's real estate or any other business. If we survive that, then it's going to convert to a balance sheet problem where the valuations are dropping. Now, glass half full, if you've kept some liquid, you're kicking yourself for not jumping in 2008 and 9. I think you should be licking your chops because come the next 6, 12, 24 months, there's going to be a lot of opportunities out there for you to buy.
Now, one of the questions, and this is a big issue that we haven't touched on, is financing these deals and lending. And obviously, right before this in Chicago, we had never seen the hard money lenders being so aggressive on interest rates. I mean, it had gotten driven way, way, way down. We all know when Renovo was the only game in town, back in the day, and then a lot of these bigger funds came in. There was a lot of competition prices. Now a lot of these lenders have gone by the wayside. One of the questions from Dr. Ali, who's a private money lender, is, can you comment on the risks to private lenders? I still represent quite a few hard money lenders, represent a lot of private money lenders. And what we're finding is that, number one, more skin in the game, right? We're loaning less on the asset and more on the person. Cross collateralization, but we're loaning less on the asset. So for a lot of you private money lenders, and especially for you, Dr. Ali, you're loaning on that asset. And one of the things, whatever business we're in, we want to control our variables, especially when we're giving other people money. And because we have volatility in the market, and because none of us are God and can predict what the price value of 123 Smith Street in Chicago is going to be during the month of June, July, August, or September, because none of us, 80, 90 years old, I don't care how old, nobody has been through a situation like this. And the way we predict the future is based on the past. So we usually have indicators that can tell us what will happen in the future. With this, we have no prior indicators because this is a first in human history for this to happen. So the key is you need to be loaning based on the person and less on the asset. And I see most of my private money lenders, they're loaning primarily on that asset. Guys, you're really involved with working with lenders. What do you say?
I'm in full agreement with everything you said, Gary. I think that's the only way to do it. I mean, you got to take your chance on the borrower. We don't know. Like you said, we don't know how far these things are going to drop. But I will tell you, I've done some small private loans myself. I would be really conservative right now. I would be conservative because of all the things that you stated. I mean, we are in a time of unknown, but that also doesn't mean that deals should stop, and it also doesn't mean that there aren't good deals out there. So that's my kind of 2 cents.
Yeah, I mean, echoing a lot of the same, but trying to add a little something. We come at this from the perspective of both I'm a borrower as well as a lender and broker of private capital for these loans. And you're absolutely right. It's the same stance that I already mentioned with tenants. If you rent a good home to a good person, they're more likely than average to pay. Well, if you do a good deal with a good person lending the money, they're more likely to figure out a way to pay it back, even if the market does come down a little bit. So I think it's twofold, right? You're lending that person that has some track record of knowing what they're doing, but also, everybody's increasing the down payment on those loans. They're lowering the loan to ARV. Some of them are bumping up the rates and the points, which I have mixed feelings about that. I mean, I understand them taking the opportunity, but you don't have to adjust it that much to make it a really super safe loan, but still provide some liquidity. Or like speaking to the guy with the question, the lenders out there, if you were doing a max loan of 70% of ARV, you drop it down to 50%, right? Go extreme. You drop it down to 50%. Well, that's still tripling somebody's leverage, like giving people the ability to, if they got 3 good deals out there, they can do 2 of them instead of 0 if you just drop the LTV way down. As a borrower, I'm hoping we keep those LTVs up a little bit, but point being that you can still lend and still be lending to good people with good loans if you just adjust the terms back a little bit, and we can still keep the market moving.
Sam is, and I think it's Sam Alley. He doesn't have his last name on his post, but he mentioned that this virus is cleansing our industry, and there's providing a lot of opportunity with this shift. I mean, a massive amount of opportunity. Most, a lot of my hedge funds, Apex National Real Estate, which is buying 10 to 20 assets a month in Illinois, they're still buying on the downswing of this because they have confidence. Now, I spoke with an Israeli fund out of California. They're coming into the Chicago market. So there's a lot of volatility overseas too. So those particular funds are coming into the U.S. market because they still, while there's instability, the stability of U.S. real estate is far more stable than, Indonesia or Vietnam or Sri Lanka. So these places where I'm representing these entities, they're still buying real estate. And that's going to keep prices relatively stable if they're going to continue to buy these assets. But Sam talks about, this is going back to the old school way where it's, 10 to 15% rates, 5, 3, 4, 5 points for your points on your loan and 6 months reserve. And obviously appraisals, $1,200 for an appraisal cost. And this allows for the cleansing of those who really have driven up the real estate prices. Ben, I don't know how many times you and I have been on the phone and you have made the comment, I don't know how this person bought this property and made money. And I said, they didn't. Mm-hmm. They didn't make money. They lost money. And there's too many people who don't know what they're doing, who have driven up the prices because they believe that the goal was winning the bid through Ryan Smith. And the win is not on paying, winning the bid. The win is on the backside when you sell that property. So guys, with respect to financing, for people who, by the way, anybody that is looking for properties and who is still looking to buy, please send me an email. I know a lot of different private money lenders. I can connect you with people who have access to these properties. If you don't have my email, it's gdavidson@castlelaw.com. Just go on to Castle Law. You can find me. I want to help you guys. There's a huge opportunity because of the shift. Jared, what do you think? I mean, isn't it true? I mean, how many times have you seen properties that have been sold over the last year or two, and you sit here and you think, how in the world did this person buy this for this number?
Yeah, I mean, and you and I have talked about it at length. I mean, I'm a real basic investor. You know what I mean? I look at some key metrics. I understand the neighborhoods, but when it comes down to it, I'm still a believer that you make the money on the buy. So whether it be a deal on the MLS, whether it be judicial sales, which I was a big player there until they began to dry up a couple of years ago. I mean, we just saw prices, and these are non-rehab homes. Just as this price is going up and up and up, I waved the flag of about 18 months ago, saying I'm going to pause. So I'm still trying to figure it out. I think that there are people that probably, eked out a little bit of money and a little bit of return, but, and specifically I'm talking about the South Side, but for me, it's too risky. If we can't get these at discounted prices, I'm out. I think people need to be careful. And, I do think this is going to get weeded out a little bit from some people that were, over leveraged and maybe thought that everything on the spreadsheets were going to come true. This is a problem, but I think we're going to see some opportunities. I don't know if during my absence, I don't know if you guys touched on it, but pre-foreclosures are beginning to rise. I track that on a daily basis here in Cook County. The court systems have been shut down until I believe it's May 18th. So, there's a bottleneck there. I don't know. It's going to be scary for some, but, I welcome it with open arms. I don't want to see people get hurt, but I also think there's great opportunities for people that are prepared. So folks that are, working with private lenders, let them know what your plan is. Let them know if you're going to kind of take a pause button. Let them know if you're going to gear up. Let them know what your plans are. It's the same thing that we were talking about earlier with tenants. You know, I look at real estate as a contact sport. I certainly can't do it alone. I've got a great team, and that team doesn't just represent the people here in the office with me. It's attorneys like Gary. It's accounting firms. It's private lenders. It's title companies, and those are the true partners.
Hey, Ryan, I unmuted you for a minute. What are you seeing in terms of absorption of your listings right now? You sell more properties than any other broker in the state of Illinois as an REO agent. What's the activity like?
In the last week, I've put about 20 properties under contract, so I'm starting to see some. We're starting to see some people out there buying. We're still getting showings on stuff. Activity was slow earlier on in the month, but it's starting to pick up a little bit. So there's some upside to that.
Yeah, and new inventory. Can you talk to me just a little bit about what's coming in the pipeline as far as REO? Do you talk to these asset managers? Can you see if it's, is it more than in the past? Is it less? What's coming in the next 3 to 6 months in terms of new properties that might be hitting the market?
I don't think we're going to see anything in the next 3 to 6 months with a significant increase. It's more of a 9 to 18 month play because we have to let everything play through. Whenever we get out of this and the courts open back up, then the forbearance starts. I think we're going to see a huge uptick later part of this year, early part of next year. There's people that are saying default numbers are going to be anywhere between, on the low end, 12%, high end, 25%. I think that 25% is a bit out there, but I think we're going to see default between probably 9 and 14% once it's all said and done. And in comparison, in 2008, default was at about 8.5%. So I think we're going to see higher default rates, and a lot of people will counter my opinion on that. But there's too many factors that we can't change, right? Unemployment's going to be supposed to hit 30 million. People don't have jobs, how are they going to afford their houses? So
we just brought everybody back to work at Castle Law thanks to my stimulus check, Ryan.
Good old stimulus. But I think it's going to be.
Never thought I'd get a government subsidy.
I think we're going to see a huge uptick in inventory probably the early part of next year, just because the courts have to play its motion.
I'm trying to figure out what the play is, and maybe you guys can tell me. Ben, Jared, Ryan, we normally think of property owners a lot of times as being large companies or entities, a lot of these funds that I represent. But there's really millions of rental units that are owned by individuals. And when I say individuals, I don't mean like Jared Kott that's got 100 properties. I mean literally one-off individuals. And if those individuals, as Ryan says, don't have income from their tenants, which we don't know. Actually, Ben and Jared, I think both feel very good about the month of April. I mean, we thought that April 1st was going to be D-Day and a nuclear bomb was going to go off. So I think I'm hearing that from all of my landlords, that it was very, very optimistic as to what we thought might occur. But we don't know what May, June, July are going to have as the shelter-in-place order continues to get extended. But it seems to me there has to be some sort of a play when these individual owners, if they do default on their mortgage payments, there has to be some sort of a play for other investors to both provide a hand up and increase their portfolio by helping these people get out of those situations. And this is more of an observation. I don't necessarily have a solution for it, but there has to be a big play. If we can agree on the premise that more people than ever have gotten involved in investing, and if we can agree on the premise that a very large portion of them have no idea what they were doing and that they overpaid, because we all agreed on all of those things, there's got to be some sort of a play there for all of these assets to buy off-market opportunities before they get into Ryan's pipeline.
To me, I think what you're speaking to, I mean, the subject to it's we've done a little bit of it. It's a lot more fiddle factor, I think, than the typical deal, because it takes a longer touch point with the client typically. But I think that's, to your point, I forget the statistic. It's like more than 90% of landlords own. What's that?
Ben, walk us through that, because a lot of the people on this call are going to not know what subject to is.
Gotcha. So you'd be buying the property from the current owner, subject to their current mortgage. So and I'm, to your point here, Gary, I'm thinking of the mom and pop players that own one or two rentals, maybe the accidental landlords, or the people that bought and they overpaid, so they chose to rent it instead of flipping it, right? So to your point, there's a lot of that in the marketplace. And so they've got their mortgage, they've rented it out. They didn't really get into this to be professional landlords. They probably didn't collect, looking forward in time, they probably didn't collect May, June, July rent because they didn't really know how, or they didn't know to call Gary and Castle Law to help with their eviction or whatever. So they're in a dire spot. They want to get rid of this thing. So you come in and say, hey, look, I'll give you a few bucks. I'll take this thing over. I will take over your mortgage. I'll buy the property from you. It's no longer your responsibility. The payment's not your responsibility. I'll make your mortgage payment. I'll collect the rent, or not, depending on how, if things are turning around. I'll collect the rent. I'll take on the risk. I'll get that completely off of your plate. And I think that that's going to be a godsend for millions of amateur landlords out there that are just cringing right now, scared to death what the next 6 months look like, because they're over leveraged and or they overbought. They were barely making money in the first place. They didn't have enough in reserves. They're in a bad spot right now looking into the future.
Yeah, no, I definitely agree. And I think that subject to is definitely a good opportunity. And then on the backside, you could sell that property on contract with a contract for deed for the same reason. Many people, maybe their credit is going to be devastated because of this COVID. And we need to have as many tools in our tool belt as possible. When it comes to investment real estate, when the market is good, even somebody like me who's not very smart can make money. But when the market starts to get tight, we need to be much, much more nimble and have those tools in our tool belt. So selling a property on contract on the backside of that subject to would also be a very good technique for people who have lost their homes who still want to be homeowners. Because again, what is selling a property on contract? It's simply you acting as the bank, right? So if a person had a finite period of time in their life where they had a major medical emergency, whether they had a death in the family, whether they had a short period of time of loss of income, and that 4, 5, 6 month period put them in a position where they couldn't crawl out, but they're otherwise good people who can pay on the backside because they go back to their jobs. They may not be able to qualify for a traditional mortgage in this real estate industry because things constrict, but they can purchase a property on contract. And here's the beautiful thing for investors, right? If we want to minimize our risk and maximize a return, when you sell a property on contract, you still control the asset. And guess what else? You're actually going to be able to sell that at a maximum retail value because that person doesn't have the opportunity to get traditional financing. But here's the other thing. It's not just taking advantage of someone, because that's not something that should be our core belief. It's actually giving people a hand up, because those people don't have the opportunity for home ownership. And we're giving them that opportunity they didn't think they had, right? So that they can build that life worth living. So guys, this has been awesome. I really appreciate it. For anybody that's listening, we're going to do these once a week until we come out of the shelter in place. The idea is to get two people who have core beliefs in helping others on to help you get through this crisis, to give you techniques on investing in real estate, to give you insights from top people in the Chicagoland area. So if anybody has any ideas on who we could bring on, what would be most helpful for you, I'm willing to take an hour out of my life and give it to you so that we can provide this value. You know, I thought a good one might be like vegan versus meat eater. We could have like Rosario versus Montreux. But
I only battle Ryan Smith. That's it. Only Ryan Smith.
All right, let's go.
So, parting thoughts, Ben, Jared, anything else you want people to take away?
I think if you're already in it, stay the course, deep breaths. This too shall pass. Like Jared said earlier, scrounge for the dollars that you can get. Just make it through this. It's going to be a real rocky few months, but you'll be glad that you stayed in it and didn't make a desperate play. If you're not already in the game, get or keep your liquidity for a couple of months and be ready to jump on some opportunities because they'll be coming.
Jared.
Yeah, mine is communicate, get your money lined up, push through this in however you need to, because like Ben said, and we've all stated, there's going to be some pretty big opportunities down the road.
Thanks, guys. So this is Gary Davidson. This is the Voice of Castle Law version 2.0, the Zoom edition. We're going to be coming back each Wednesday at 1 o'clock. This video is being recorded. So for those people who have your emails, we're going to boost out that email to you, and you can send it to your friends who haven't had an opportunity to see it. We'll also post it on Facebook for people if they want to view the video. A lot of good insight. Ben, thanks for coming on. Jared, thanks for coming on. Ryan, thanks for Cosmo Kramering us and coming on. And we'll talk to you guys soon. Thanks so much.
Thanks, guys. Bye-bye.